Microsoft, one of the largest tech companies in the world, has created 3 billionaires, but it also has created over 12,000 K millionaires. That's the big number in the fact how we have more millionaires that ever had, largely due to the rise of the internet and globalizations. But making money or keeping your money isn't easy because the world is changing so fast that if you aren't smart enough, you might lose your wealth and blink on the eye. That's why an average millionaire has 7 streams of income. You don't want to put all of your eggs into one bucket. If something goes wrong, you go doomed. So let's find out the different streams of the incomes. Ordinary income is the most usual type of the income, which is also known as the ordinary income. It includes wages, salaries, bonuses, and commissions. And it's when you are directly trading your time for money. Of course, it has its own limitations since your time is always limited, but that's not the only problem with this type of the income. 2018, the government US collected $3.3 trillion in the taxes, and more than half 51% of that came from the income taxes. In comparison, the corporate income taxes only made 8% of the government revenues, which means people with this type of the incomes pay most of the taxes. Another 35% of the revenue comes from the payroll taxes, which is supposed to be split between you and your employer to fund social security, medical, and so on. But researchers has shown the employers pass their portions of the cost to workers. So people with earned income pay 86% of the taxes, while billionaires pay almost nothing. In one way, it's the easiest from income because you don't have to do a lot of the thinking or the taking any risks. With some set of the skills, you can find a job. That's why it's highly taxed, but it's not sustainable at all since if you lose this job you lose your only source of income. But don't worry, in this video you will learn that type of the income millionaires or the billionaires have to make so much money while avoiding taxes completely. Secondly, capital giants. Capital giants is when you buy the asset such as the stock or property and then sell it for the higher price. That profit margins your capital giant. Let's say you buy 100 stocks for the $100 each, or $10,000 in the total. The stock's price rises to $120 and you decided to cash out $12,000. So your capital gained $2,000. The tax rate is typically around 15 to 20% at best on capital giants on the long-term investments, and 37 in the short term. And if you pay attention, it's really popular among the millionaires, not because the tax rate is just 20%, but if you are smart about it, you can literally pay zero tax on it. The first way, one is super easy. Just don't sell. Keep holding your investments. Even if you make billions of the dollars, you don't have to pay a dime. But that might not work for everyone. You might have to sell some of your investments to have cash on your hands. That's why there is a second way. Tax losses harvesting. It's when you sell investments at all and a loss of reduce your tax bill. At first glance, it doesn't make sense. Why would you purposely lose money? Let me explain. Let's say you are the professional investors and you have the multiple stocks into your portfolio. A stock A increased by $300,000, which is great, but unfortunately your stock B decreased by 25%, your $200,000 investments. Now worth only the $150,000. And let's say you want to sell $50,000 of your stock A to have some cash. Ideally, you should be paying 15% capital gain tax, $7,500. But there is another way to sell your stock B first from the $150K and buy a similar investment for the same amount, $150,000, to realize your loss. Since you have $50,000 of realized loss, you can deduct it from your tax bill. So if you are selling $50,000 from your stock A, you can deduct the $50,000 losses. Boom, your tax bill is zero. $50,000 capital gain from the stock A, realized losses 7 from the stock B, 15% capital gain tax equals zero. It's much more complicated than this, and I have oversimplified it and ignore a lot of the details, but this is the idea behind it. Usually it's not done manually but rather through the computers with the specific algorithm that makes it much easier. Investors continuously sell their better investments and received the money back into smaller assets to realize losses, because you can keep carrying them forward for the rest of your life. So when you make the capital gain, you're either dramatically lower your taxes bill or pay nothing at all. Third, dividend income. But that's not the only income you can get from the purchasing stocks. Owning stocks is like the owning the piece of the company, even if that means owning a such small percentage that it won't make any difference. And it's understandable because the companies nowadays grows to $1 trillion. And as one of the owners, the company has to share with you its profits as a form of the dividends. However, companies usually don't pay dividends even if they make billions of the dollars, such as Google, Boeing, or Facebook, because they keep the profits within the company to reinvest it back. That's why most investors are concerned about the stock price and not the dividends. But companies like the Apple do pay dividends. As of November 2018, Apple paid shareholders dividends of 73% per share. That's not much, but something is better than nothing. Dividends income is taxed based on your income tax balance. Most people would fall between 12 to 24%. However, there is still a way to avoid those taxes as well, but we will keep that for another video. Fourth, next, rental income. Rental income is probably everyone's favorite. You buy the property and then rent it out. It's most passive, where you don't have to be actively involved. However, from my experience, it's much more time consuming than most people think. Tenants come and go. Some stay for a few months, others for a few years. Some take care of your property, others don't give a damn. Some pay on your time and won't get you a single problems. Others are just unnecessary headache. So it has its pros and cons. However, there is also commercial property that you rent out to businesses, which in some case is a better idea. Theoretically, you rent almost anything starting from your car to your phone. However, real estate is the most common one. Fifthly, royalty income. In 1997, the guy named Jeff Bezos filed a paper, the method for the ordering items online instead of first adding your item to your shopping cart and then clicking buy on Amazon. You could simply click buy. It sounds too simple that no one should have pretended that, but for at least 2 decades, Amazon made billions of the dollars licensing this patent to companies such as Apple. That's why corporations file for a lot of the patents, even if they don't need them, because they could be the potential source of the income. This is the real passive income. So you keep getting paid after your work is done, but that also includes writing books, shooting movies. This form of income is usually popular among the artists, musicians, for example, usually make money by the letting other people use or sell their musics. Interest income. It's one of the easiest and the simplest way to generate income. It's more of the passive income where you are not actively involved in it. That's where rate of the returns is typically much lower than the other forms of the investments. Where it's when you lend money to the government, banks, or corporations in the form of the bonds. The bank usually takes your money and lend to someone else at a higher interest rate. It keeps collecting the payments from the border. They pays you back your portion of the deal and pocket the rest. That's how the bank makes money in the short. The government usually raises money in the form of the issuing bonds. So they so when you are buying the bond, you are lending money directly to the government. Seventh, and finally, business income. It's exactly what it means: the income you earned as a result of doing your business, either by the selling something or providing some kind of the services. And this is probably the most important one among all of this type of the income, because with other forms of the incomes you can expect 5, 10, maybe 15% rate of the return, and the job is to minimize taxes, but that only works when you already have some wealth. But with this form of income, business comes, you can have the 1,000% return just with the $100, especially since we have this thing called the internet. Of course, having the multiple source of the income is the great. If one of them fails, you still have many others running. However, it's also the big distractions, meaning one source of income is a full-time job. That do you think happens when you have the multiple of them? So do not jump from one income to another. Put all of your efforts into the mastering one of them first, and once you reach the level when you are earning enough to create another source of the income with the minimum effort, then move on. And if you give it a close look, that's how people get rich in the first place. Just a little disclaimer: most of these things were oversimplified to make this video as short as possible, but I believe it's important to understand the different type of the income. This is why the rich get richer while they're paying minimum taxes, while the middle class pays a 40% tax rate. Give this video a thumbs up if you have found helpful. It helps the channel, and if you are new here, make sure you hit that subscribe button and the bell besides it. Thanks for watching, and until next time.